Hello and welcome to another session of the My Solo 401k Financial My Community Daily Webinar Series. Thank you so much for joining. We're here today to discuss Big Beautiful Bill. Here's what your advisor gets wrong, specifically about Roth conversions. So if you end up finding this video to be helpful, please like this video. Please share it with others who you think might find it to be useful, as it helps us to get the word out. Also, we invite you to subscribe to our channels, whether on YouTube, LinkedIn, X, Instagram, however you're watching today. That way you get notifications of when we go live. We go live twice a day, once at 10 a.m. Pacific, 1 p.m. Eastern, then we're back again in the afternoon at 1 p.m. Pacific, 4 p.m. Eastern. So we always like to share content. Also, we invite you, if you have questions or comments, to please chat those over, as we love to go through those. But yeah, we want to get started today again with the hot topic, which is the Big Beautiful Bill. There's been, you might see people who post on social media, advisors, financial influencers, etc., who are posting about the Big Beautiful Bill. And specifically, we've come across some that post about how changes to the Big Beautiful Bill are making Roth conversions not as attractive. And the analysis is really not complete in our view. It's a very surface analysis. We wanted to take the time to go over and share our perspective. As always, the presentation is being provided for educational purposes only and should not be construed as tax, legal, or investment advice, nor is a solicitation. When making an investment decision, please consult with your tax attorney and financial professional. So what is a solo 401k? Let's lay the foundation quickly with what is a solo 401k, what's a Roth conversion, and then we'll share the analysis that is out there, and then our perspective on that, which is going to be a little bit more in depth. So what is a solo 401k? Well, really, it's a retirement plan for self-employed individuals with no full-time employees other than maybe a spouse, right? So the solo 401k owner themselves, their spouse, they can be an employee, but the self-employed person can't have any non-owner, non-spouse, full-time W-2 employees really working for any business owned by that person or spouse, if any. So it's an owner-only plan. So it's a 401k, but it's just really for the owners of the business because there are no other employees that are eligible. So a solo 401k offers tremendous benefits, just generally speaking, right? For example, it has the highest contribution limits for any defined contribution plan available to self-employed individuals. For example, for 2025, individuals are going to be able to contribute up to $70,000 or even more if they're age 50 or older. Now, there are basic plans out there, for example, at discount brokerage firms, but those plans are not going to support advanced features, right? They're not going to support oftentimes Roth, or if they do Roth, it's just a basic Roth. It's not going to allow you to do the mega backdoor Roth, not going to allow you to do the Roth conversion, not going to allow for loans or alternative investments, or make the self-employed business eligible for a $1,500 tax credit. These are all the features of our plan. So our plan gives you all of that, right? So that's what makes our plan so attractive. And many people will want to upgrade their plan to our plan if they do have a basic plan out there with a discount brokerage, and that can totally be done. It's done every day. We're helping customers do it every day. So eligibility, again, is you got to have self-employment activity. So you report earned self-employment income on your taxes. Could be on Schedule C, for example, if your business is taxed as a sole proprietor. W-2 wages, if your business is taxed as an S Corp or a C Corp. Or income reported on a K-1, specifically line 14 of a K-1, in the case of a business taxed as a partnership. That's the first prong of the eligibility requirements. The other piece, the other prong, is that you, again, cannot have any full-time, non-owner, non-spouse employees. So that's what gets you in the game to be eligible to set up a solo 401k. Then you need to set up a plan like our plan that allows for in-plan Roth conversions. So what is an in-plan Roth conversion? Well, this is when someone has money that's already in their solo 401k that's in a pre-tax status, and they want to move it to a Roth status, so to an after-tax status. So this could be money that's in your plan because you made a contribution, right? You might have made employee or employer pre-tax contributions that reduce your taxable income at the time that you made the contribution. Or it could be other pre-tax money, say that's in a former employer plan or a pre-tax IRA that you roll over to the solo 401k. So if you have a plan like ours that allows it, you can convert those funds from a pre-tax status to a Roth status. So the amount converted is going to be taxable in the year of the conversion. So if you convert the money that's in the pre-tax account, all or some of the money, to a Roth account because your plan allows it, and you do that during 2025, that's going to be taxable for 2025. So you have to add the amount that you converted to your taxable income for 2025. But then the money will be inside your Roth solo 401k, where it will have that potential for tax-free growth. In other words, at the time that you ultimately withdraw from the Roth solo 401k, if you do that as a qualified Roth distribution, you'll be able to take out all the money, including the gains, totally tax-free, totally penalty-free. So the mechanics of an in-plan conversion are no income limits or age restrictions, right? So it's not as if you make too much money, you can't do it. Or if you're not of a certain age, you can't do it. You can. There's no such restrictions. There's no triggering event required, right? If you wanted to transfer money out of your solo 401k, say to a Roth IRA, generally speaking, you'd have to meet a triggering event. For example, being aged 59 and a half or older. But if you're simply moving money inside the plan from a pre-tax status to a Roth status, there's no triggering event required. Your plan must allow for Roth funds and in-plan Roth conversion. That's why I was talking about earlier, how there are some basic plans out there that may allow for basic Roth contributions, but they're not going to allow for in-plan Roth conversions. Now, when you move the money from a pre-tax status to a Roth status, it's going to be not only taxable, as we described, right? The amount that you convert is added to your taxable income for the year of the conversion, but it's also reportable. It needs to be reported on a Form 1099-R. Now, we handle that as an optional free service. In other words, no additional charge for our customers. They just have to let us know when they make that conversion so we can capture the information and simply add them to the queue to be able to prepare the 1099-R. So the 1099-R is going to be issued at the beginning of the following year. So for example, for those that are converting from a pre-tax status to a Roth status here in 2025, that's going to be issued and reported on a 2025 1099-R, which would then be provided to the customer at the beginning of next year. You've got to have separate Roth and pre-tax accounts. So it's not just something you note in your records. You literally have to move the money from one account for pre-tax solo 401k funds to a second account for Roth solo 401k funds. So that's our foundation of what a solo 401k is, eligibility, what's a Roth conversion. So what is the common advisor analysis out there, just generally speaking, when you might be considering pre-tax versus Roth? Oftentimes it boils down to a simple question, right? Will your tax rate be lower now or in the future? And there is some truth to that, right? Because the idea is that, okay, I'm going to pay taxes now at a certain tax rate versus paying taxes later at a future tax rate. So if my tax rate is going to be lower now, then ultimately I'm going to pay less in taxes, right? If not, don't, right? That's oftentimes the analysis in very simple terms. The problem with this analysis is that it assumes the tax payment will come from the retirement money itself, right? That you'll be reducing your 401k pre-tax balance by the amount of taxes that are owed on account of that in-plan Roth conversion. So that's one faulty assumption. Additionally, it ignores the possibilities of paying taxes with non-retirement funds. It ignores the long-term value of tax-free compounding of funds used to pay the taxes versus the tax drag on the growth of those taxable funds. So to put it in simple terms, right? If someone were to process an in-plan pre-tax to Roth conversion that required them to say pay $10,000 in taxes. So if they use non-retirement money to pay those taxes, now they'll have the entire amount that was in their pre-tax account that was moved to the Roth that now is going to be in their Roth account that can grow potentially tax-free. So all this, the opportunity cost of that is that that person doesn't have the $10,000 that was in their non-retirement account to be able to invest those funds. But so really we're comparing, should I continue to invest the $10,000 via a non-retirement account, or should I have it in a Roth account where it's going to potentially grow tax-free? So there is a more sophisticated analysis that looks at that, what they call tax drag on the growth. Because if you say keep the $10,000 in a bank account that pays interest, that individual will have to pay taxes on an annual basis on that interest income. Or let's say it's in a dividend paying stock, that again, paying taxes going forward every year on that income, right? Or if there's capital gains that are realized. So regardless of what it's invested in, because it's non-retirement money, there will be taxes that are due on the growth. So that's going to ultimately present a drag on the growth of that $10,000. Whereas if the funds are in a Roth account, they're going to grow tax deferred, potentially tax free, if when the person takes a taxable distribution from their Roth account, they're able to take it as a qualified Roth distribution. So that is the issue in a nutshell. And ultimately, based on analysis by third parties, for example, there's a study out there published by Vanguard, even if your tax rate is lower in the future, it may make sense for that individual to process an in-plan Roth conversion now. Now, we're going to put some more meat on the bones and give you an example where we really illustrate how that works. But we also want to introduce the big, beautiful bill, because that's part of what's driving this discussion here. So again, if you look at some of the third party and commentators' analysis of the big, beautiful bill, they're saying that the big, beautiful bill is making the Trump era tax cuts permanent, which is true. But what does that mean when we say permanent? It just means that there's no sunset provision. So that doesn't prevent, for example, a future Congress or administration from passing another law that raises the taxes, right? So it's not a guaranteed permanence. It's just permanent from a Washington perspective, that there's no sunset provision, right? So Washington, future administration, future Congress can change tax policy at any time. So with the idea being that of these third-party commentators that, well, if the tax cuts are permanent, right, so that's reducing the efficacy of a Roth conversion. But again, that's not considering, that's a very simple surface analysis. So the more sophisticated analysis, for example, that's in the Vanguard paper that I alluded to, is referred to as a break-even tax rate strategy, or better strategy for short. And to make it simple for us, it really boils down to using personal funds to pay the conversion taxes, which will allow the entire 401k amount that's converted to stay invested tax-free. So in short, what the individual is doing is using tax inefficient assets, because I was explaining how even if you're investing those, even if you would have invested the money that you use to pay the taxes, it's going to be relative to a Roth account, it's going to be tax inefficient, because even if you're investing and there's gains year after year, you're going to typically have to pay taxes on those gains. So you're effectively shifting those tax inefficient assets into a tax-free environment. So the more that you use personal funds, and the longer that you have the money, the longer the money that can grow inside the Roth account, the bigger that difference can be, which means that even if you end up with a relatively large difference between your current tax rate and your future lower tax rate, it still might make sense for that individual to process an in-plan Roth conversion now. That's essentially the takeaway of the Vanguard analysis. So here is an example under using this better strategies for a pre-tax to Roth in-plan conversion. We have Alex, who's 45 years old, a self-employed designer with $100,000 in a pre-tax solo 401k. Their current marginal tax rate is 35%, and we're assuming that they've got a future tax rate of 24%. So surface level analysis, right? If we go back to that, it would say, okay, well, future tax rate is lower, don't process a in-plan Roth conversion. But let's assume this person has a horizon of 20 years. Let's assume that the return on the money is 7%. So if they were to just not process the conversion, that means, of course, they wouldn't pay any taxes, right? So let's say that that $100,000 triples to $300,000 over that 20-year term, which approximately it would do with a 7% return. So when they ultimately withdraw the money in 20 years, remember their tax rate is lowered, 24%. So they're going to pay $72,000 in taxes, right? So that's 24% of $300,000, giving them after-tax money of $228,000. Now let's look at the other scenario. Let's say they process a Roth conversion. And let's assume that they pay, in other words, at their current tax rate of 35% on the $100,000 that's converted. So the Roth account is going to grow, right? Which is assuming that's going to be invested in the same thing with the same return over the same period. It's going to grow from 100,000 to 300,000, just like option one. Now they'll be able to withdraw that money. Let's assume that at the time of the withdrawal, right, they meet the qualified Roth distribution requirements, which they would in this scenario. So they're going to be able to withdraw the $300,000 totally tax-free. But to be fair, you do have to discount that by the $35,000 that they would have had, right, if they had not processed that Roth conversion 20 years prior. But that's where the better analysis comes in, where we talk about the drag by annual taxes. Because the $35,000 that they invest, it's going to be invested as a non-retirement investment. So it's going to be relatively tax inefficient compared to the Roth money that's growing, of course, tax-free. Because, for example, if they're invested in, say, some dividend-paying asset or an interest-bearing asset, they're going to have to pay taxes year after year. So they're going to have to give back some of those gains year after year. So the value of that $35,000 is not going to go up as much. So let's assume that it grows, it only doubles as opposed to triples. So even if we account for that opportunity cost of the $35,000 that they used 20 years prior to pay for the Roth conversion, and we reduce the $300,000 by that $70,000, we're still in a better place. Like we ultimately have $230,000 of after-tax money versus $228,000. So this better analysis is a good tool in the toolbox. Ultimately, of course, as we talked about, we're giving this for educational purposes only. You're going to want to discuss with your tax and financial and legal advisors. But I think it's a more sophisticated analysis, as it's really not as simple as just saying, okay, tax rate lower in the future compared to higher now, therefore it doesn't make sense to do a Roth conversion. Because as you can see here with this example, even with a relatively large difference, 35 versus 24%, the Roth conversion still may make sense. All right, great. So hopefully that's helpful. So just to kind of sum it up here, and again, if you do have questions or topics, don't hesitate to chat it over. So why the better strategy may work, right, is that you're using taxable money, which is maybe relatively tax inefficient. So it's going to suffer from tax drag based on interest, based on dividends, based on capital gains. And you're effectively shifting those funds into a potentially tax-free account. As we talked about, the difference is only going to get bigger over time, right? So the longer horizon you have, the more powerful it could be. So that's really the crux of why the better strategy may work. Why the solo 401k provider matters is that you need to have a plan like ours that allows for in-plan Roth conversions. And it's going to be also make sense for you to work with a provider like us that'll handle the 1099 reporting as an optional free service. In other words, no additional charge, that has experience with guiding you through the required compliance steps, like the multiple sub-accounts. And keep in mind that just because a provider does allow for Roth contributions, that doesn't mean they're going to necessarily allow for in-plan Roth conversions. As we've seen, many of the discount brokerages that don't offer the in-plan Roth conversions. So a couple more key takeaways, right? Just not to necessarily rely on the basic surface analysis of just a basic tax rate comparison. Again, understand your provider's limitations. The key here is using the non-retirement money for taxes to optimize growth, to make smarter use of those inefficient tax dollars. So as always, we invite you to our community. It's always free to join. All are welcome. We've got over 30,000 members. We've got vibrant forums. We have libraries of videos and webinars. We have the industry's first AI, which is all totally free to use. You can use the AI at solo401k.ai. You can join the community at mysolo401k.net/my-community. Please like the video. Please subscribe so you get notifications of when we go live. And until next time, thank you so much, everyone.